Hello and welcome to FACT's webinar, Building Soil Wealth and Legacies, Infinite Banking for Regenerative Farm Succession. Our guest is Dana Tinney Wilson with Chantilly Ranch. I'm Samantha Gasson, FACT's Humane Farming Program Director, and I will be moderating this session. Thank you for joining us. Before we dive right in, let me take a minute or two to do a few quick introductions. Food Animal Concerns Trust, or FACT, is a national nonprofit organization that works to ensure that all food-producing animals are raised in a humane and healthy manner. We accomplish this by supporting humane farmers through our Humane Farming Program, promoting policies that make foods from animals safe and healthy to eat through our Safe and Healthy Foods Program, and generally help consumers make informed food choices. Please visit our website at foodanimalconcerns.org to learn more about all of our farmer services. As always, I would like to welcome my wonderful colleague, Catherine Hoke, who is joining us to help field questions and take over if my internet decides to crap out. Okay, at this time, I am delighted to introduce our esteemed presenter, Dana Tinney Wilson with Chantilly Ranch. Dana is the founder and owner of Chantilly Ranch, a three-generation regenerative ranch that she runs in Northern California with her parents, husband, and three children. In pursuit of profitability strategies for that ranch, Dana found the infinite banking concept outlined by R. Nelson Nash and has become a practitioner of the concept. She now uses it to mentor other ranching families to help them move their operations from unsustainable to financially regenerative. When she's not mentoring her clients on the infinite banking concept, you will find her with her children on horses out in the pasture, checking their cattle and living the absolute best life. We are super lucky to have the knowledgeable Dana with us today. Without further ado, Dana, I will turn the floor over to you so that you may begin your presentation. And while we're getting that situated, I am going to run a poll.
Thank you so much. I'm going to share my screen. All right.
Everything looks good, Dana.
Wonderful. Okay. Let me back up here. There we go. All right. Welcome to Building Soil, Wealth, and Legacies, where we'll be discussing infinite banking for ranch and farm succession. I've thrown in some pictures of my livestock for attention because this topic addresses the kind of inevitable that nobody wants to talk about. But I'm going to rip the Band-Aid off and we're just going to jump right into it. Let's consider a hypothetical ranch family running a 250 head cow-calf operation. There's an owner and a spouse, and they have three adult children. One of them works on the ranch, while the other two have moved off the ranch. The family experiences a devastating death of the rancher. Let me remove that a little bit so I can see. All right. Unfortunately, there was no succession plan in place and no life insurance in place. So what happens? Well, regardless of any planning, the family experiences overwhelming grief. So I chose an AI generated fake image for this slide because this image doesn't exist. This family goes through this devastation in private. But as we know, on the ranch and on the farm, even in the face of great loss, life goes on. Final expenses come due, bills need to be paid, work needs to be done, and inheritance questions are asked. And this is where chaos and family division can ensue.
Dana,
without enough capital. Yes.
would you like to know the results of the poll?
Yes, please.
Okay, so 85% do have a savings plan. 76% do have a life insurance policy in place.
Wonderful.
And of those, 53% are whole life, 42 a term, and 21 are not really sure what they have, which is probably me. And 70% have successors, and Only 45% know the value of their operation and 60% do not. And I'm in that 60% as well. So,
That is not surprising. Those numbers align very much with what we've seen. So thank you for that. Thank you for everyone involved in that. Okay, so back to our situation. If we don't have enough capital, the working heir, the person who's left on the ranch, may need to sell livestock, which would undermine years of selective breeding, and it could cause the mismanagement of pastures without those animals on them. The whole thing could result in forcing the sale of the ranch or the farm to fund the inheritance. So, this is the sad reality for far too many ranching families, but it is preventable with proper planning. So, as we said before, I'm Dana Tinney Wilson. I'm the owner and operator of Chantilly Ranch, which is my family's three-generation regenerative ranch in Northern California, where we raise goats and cattle. I'm also the wealth strategist at Alpha Omega Wealth, which helps families create and manage generational wealth. So, with that context, let's get back to our hypothetical ranch family and rewind time to help them set up their ranch for success and succession. So, the question that we have to ask is, how do we keep the ranch profitable and in the family? So, step one is we have to identify the total assets on the ranch. Assets are resources that you own or control that provide an economic benefit now or in the future. Simply, assets are something that make you money. So on this ranch, on our hypothetical ranch, we've got a property value of 3 million. We have livestock worth 1.1 million. And then we have equipment like tractors, fencing, trucks, side by sides for assuming 500,000. Then we have our improved pasture and its standing or its potential forage for over 200,000. So that's a total asset value of above 4.8 million. But we also have to keep in mind intangible assets like tacit knowledge. This is the know-how that keeps the ranch running, which is really important to regenerative ag. So once we have our assets totaled, we can move on to step two, which is placing all of our assets in a living trust and stating our intentions very clearly. This step requires an estate attorney and is an entire presentation in and of itself. But the goal here is to avoid probate. So we don't donate any of our estate to the government. Little warning here, an estate of this size could pay hundreds of thousands of dollars going through the probate process before any money even gets distributed to the heirs. So let's make it a priority not to do this. Once that's completed and we've got everything in the living trust, now we can skip over to step three, which is to identify our liabilities. Liabilities are just the opposite of assets. They are obligations or debt and that we have to pay now or in the future. So by definition, a liability is something that costs us money. On this ranch, you can see there are mortgages, vehicle loans, annual expenses, salaries, and they total about 2 million. So now that we have a clear picture of our assets and our liabilities, we can move to step four, which is to determine a total valuation that helps us calculate the inheritance for each heir. This is a simple ranch or business valuation where we take the assets and we subtract the liabilities. This gives us a simple valuation of 2.8 million. So we divide that across four heirs. Remember that we have the surviving spouse, the working heir, and two non-working heirs. So that's about 700,000 each, which means over 2.1 million is kind of earmarked for the non-working heirs. So I hope we can see the glaring problem here. Where do we get over 2 million to take care of the family members that aren't working the ranch? So personally, I have three children, one who's old enough to work the ranch with me, and two that are still in school. So it kind of is yet to be seen what they're going to choose. And as a parent, it would break my heart to see my daughter, who is the oldest, have to sell the ranch to buy out her younger brothers. But at the same time, I want my sons to be beneficiaries of the business that I've built, no matter what kind of life they choose. It's at this point that we have to make some decisions. So step 5 is to identify the successors, excuse me. In step 2, we placed all the assets in the living trust. Now we have to identify who is going to inherit the ranch and the working part of it. And we have to provide instructions on the inheritance and how it should be distributed to the working and the non-working heirs. These instructions need to be crystal clear. If we don't have enough capital in our estate to provide an inheritance to our non-working heirs, as well as keep the ranch running for our successor, we leave our survivors kind of pinched between a rock and a hard place. And that's definitely not what we want. So step 6 addresses this issue. This is our strategy to fund the ranch for success, where we can create enough working capital to meet everyone's needs and wants without selling or fighting. Our strategy is to use infinite banking policies to fund buyout agreements and leave working capital for everyone. Infinite banking is a concept that utilizes mutually owned, dividend paying whole life insurance policies that are properly structured to save and grow money while providing access to those funds over the entire course of the contract. They include a death benefit, a banking and financing function, living benefits in the form of long term care, and major tax advantages. So let's see how an IBC policy would work on our hypothetical ranch. Remember that this is a ranch that's running a 250 head cow calf operation. Assuming an 80% live calf rate, that would mean that they end up with about 100 steers each year. And each year they would sell 100 of them at 1,000 pounds, which in today's prices is about 3,500 per head, give or take. So that translates to about 350,000 in annual calf sales each year. So our advice is to divert 20% of that income directly into a whole life policy. And a quick little side note, don't get hung up on the exact numbers. The important part is that we make a recommendation to save a portion of the ranch's income. That's the important thing here. For you, it might not be 70,000, it might not even be 7,000 per year. And it might not end up being 20%, maybe it's less, maybe it's more. Again, it's just the important part is to create a savings habit. And we recommend putting as much as possible into the savings. So we take this advice, we jump into a time machine, and we go back in time. And we help the rancher take this action starting at age 25. In year 1, he puts his 70,000 into the policy, and then a little under half is available in cash value. We'll talk about why that's important in just a minute. And he immediately has a death benefit available. So this is an immediate estate. If he dies in year 1, even in day 1, he leaves 3.6 million to his beneficiaries. Note that this action, just diverting 20% of his income to a whole life policy, solves the inheritance program, just like that, right? He can split that money across the heirs and no one needs to sell anything and everyone's taken care of. But let's jump out to year 5. Each year he has put in $70,000. So on year 5, he's put in 350,000. He has about 300,000 in cash value, and the death benefit is up to over 4 million. Unlike if he were to invest his 350,000 into a retirement account, the cash value is accessible to him. And coming up, I'll show you how. But first, let's look at how this policy continues to perform over time. I chose to look at year 9 here because something special happens. The premiums going in are 630,000, but the cash value is over 642,000. This happens because the premiums grow at a guaranteed interest rate and the company pays dividends when they make a profit. Those dividends get added to cash value and then continue earning interest. This is what happens with a properly structured whole life policy. At a certain point, the cash value outpaces the premiums that have been put in. And in year 9, our rancher has access to more money than he's placed into the policy. And his death benefit continues to grow. So let's keep going out to year 20. At this point, the rancher has put in 70,000 per year for 20 years. So naturally, that's 1.4 million in premiums. But the cash value has grown to 1.9 million and the death benefit is over 7 million. The next year I want to look at is the 30th year of the contract. And this year is special because at this point, the premiums reduce to almost half. He's put in 2.1 million. He has a cash value of 3.8 million and a death benefit of over $9.5 million. At year 50, the premiums stop. So he has put in a total of 2.8 million. There's a cash value of 10 million and a death benefit of over 14 million. At this point, there's no more premiums entering the system. And at year 70, the total premiums, like we said, are still 2.8 million, but the cash value is now over 20 million and the death benefit is over 23 million. So at this point, if our rancher passes away, the family at age 95, the family is more than set. All the heirs are taken care of financially, and the ranch has an influx of cash to continue running smoothly. So let's go back and talk about the cash value and what it means to be accessible. Whole life insurance policies guarantee a certain percentage of growth on cash values, and they allow their owners to take collateral loans against that cash value. The growth interest rate and the terms of the loans are set at the beginning of the contract, and they remain fixed throughout the entire life of the policies. Contracts being written today are compounding cash values at a rate of 3% annually, and that is guaranteed growth. It's also tax-free. At the same time that the cash value is growing at 3%, the insurance company is obligated to allow the owner to take collateral loans against the total amount of the cash value that's in the policy. And they do that at a fixed rate of loans at 4%. So that's a mouthful. Let's take a look at an example. Back in year one, our rancher's cash value was about 34,000. So he takes a loan at 30,000 just for simplicity's sake, and he takes the loan at 4% for 5 years. He'll have monthly payments of $552 and he'll pay a little over 3,000 in interest for the use of that money. And here's where the magic happens. This is why I get excited and why we call these policies infinite banking. At the same time that the rancher is accessing the use of his cash value, he is also still earning 3% for that whole 5 years on the cash value. So at the end of that period, he's earned over 4,000 on his money because it stayed in the system earning compounding interest. So he was able to use the money, pay himself back, and he actually earned a net profit of 1633, which is the interest earned minus the interest paid. For those of us who need to see a visual, let's look. This is the interest on the $30,000 loan across 5 years. So at 4%, the loan costs our rancher a little over $3,000. Meanwhile, the cash value continues to earn 3% for a total of $4,778, which outpaces the interest charged by 1633. Again, he was able to use the money and come out on top. This is a repeatable, profitable process that replaces the banking function for the whole ranch. Let's look at a loan in the 5th year. Now the rancher has over 300,000 in cash value. So he takes a $300,000 collateral loan for 10 years this time. Still at 4%, he'll end up paying 64,000 in interest. At the same time, his cash value is still growing at 3% for the whole time. This earns over $100,000 in interest, and that nets him a positive 38,000 for the use of his money. Again, this is interest earned minus the interest paid. These are loans taken against his own money that recaptured dollars that he might have borrowed from like a traditional bank or credit cards using traditional financing, where he would be paying higher interest rates and sending all of that interest money to the banking institutions instead of his own family. Keeping this money private like this creates generational wealth. Okay, we'll do one more example using large numbers now. Now, in year 20, our rancher has over $1 million and is able to take $1 million collateral loan from his cash value at 4% for 20 years. He'll pay a total of 454,000 in interest, but he'll also earn 806,000 in interest. So that's a net gain of 351,000 for the use of his own money. Again, here's a visual. So this is the interest that's charged at 4% over 20 years. And here's the visual of the interest he'll earn at 3% over the same time. That's a net gain of 351,000. So the question now is, what can our rancher use that $1 million for to make the ranch more profitable? And the options for what you can use a loan on are basically infinite. He can buy more land, cattle, more irrigation, more equipment, more fencing. He can invest it into other places. The idea is that he can use these collateral loans to replace his traditional debt. And the process to actually procuring one of these loans is very simple. The rancher would just request it from his agent and then wait a few days for funding. There is the only limit for the amount that he can have is the amount of his cash value that's built up in the policy. There are no credit checks, there's no debt to income requirements, there's no use limitations, and the insurance company is obligated to lend to its own policy owners. Also, the repayment options are very flexible and they can include pausing payments indefinitely if that's absolutely necessary. So the full scope of this infinite banking whole life policy being used correctly like this changed the trajectory of this family's financial picture. They went from losing the rancher and then the ranch to creating generational wealth for the whole family. And almost as a side note, although it's very important, is that there's a whole other side of these whole life policies that can make all the difference for the rancher if something less than lethal happens to him. If he gets a terminal, chronic, or a critical illness, he can access a portion of that death benefit to fund the necessary expenses to heal from those illnesses or get through them. It's just a little extra peace of mind in all of these policies. Okay, so all of that discussion on infinite banking policies was step 6, which is funding for success. So now we can get into step 7, planning for generational wealth. In this step, our rancher adds instructions to his living trust to use his death benefit to fund the whole life policies for future benefit or for future generations. This creates a flow of wealth from one generation to the next. The first generation establishes policies on themselves, shares that knowledge, which is the information that we just discussed, with the next generation, and then leaves a financial legacy in the form of their death benefit, which is used to at least partially fund the next generation's policies. The next generation already knows how to use the policies for all of their banking functions, and they pass on that knowledge of how to use them to their children. That third generation takes the helm free from debt, armed with the knowledge of using their own family funds for opportunities and financing. They have long-term care security and they have their death benefits ready to fund their children's policies. So this cycle of independence from traditional financing goes on and on inside their own private family banking system. So this sounds great, right? But what are the drawbacks? So the most important, this is the first and the most important, is that to qualify for a life insurance policy like this, you have to be insurable, and that is based on your age and health status. Not everyone is insurable. When you apply for a policy, the life insurance company puts you into underwriting to make sure that there are no disqualifying health concerns. This is part of the reason that we went all the way back to the rancher when he was 25, when he's young and healthy. This is the best time to secure a policy like this. As you age and collect illnesses and injuries like we do, your insurability potentially reduces. So it's up to us who are maybe not 25 anymore, not so young, not so healthy, to be the influence that our children need to get these policies set up. I have them on all of my children as well as myself. And just like in the generational flow, I help them understand how to use them. This is not a set it and forget it. This is a working system. These policies require discipline and consistency. And for a young person, that's probably the hardest aspect of this concept. You need to fund these policies, and placing 20% of total income into savings each year might be very difficult. There's also a strong pressure from mainstream financial professionals to invest instead of save in a whole life policy. That's a whole other can of worms here, but I'll say this much. Number one, the cash value in a life insurance policy grows guaranteed without the risk of being lost in a down market. And number two, because the cash value can be used through collateral loans in any way that the policy owner wishes, the cash value can be used to invest in other opportunities while it's still growing at a guaranteed rate of 3%. So my advice is to first place the funds in the life insurance policy and then go invest them if that's what you want to do. So the next barrier to these policies is they require long-term planning. I actually think this is one of our superpowers though, because in regenerative agriculture, our vision is already many generations down the line, which is why I think that infinite banking fits so perfectly for regenerative ag producers. Because a wild and crystal clear vision for the future is necessary. And I think most of us are blessed with just that. So let's reiterate the steps to set up our ranch or farm succession with infinite banking. First, we start with determining the value of our operation. Then we calculate what we can afford to save in the form of premium payments, whether that's 10% of your income, 20% of your income, or something completely different. There's no minimum or maximum. We just need to determine what fits our budget. Then we find a life insurance agent that specializes in infinite banking. Listen, most whole life policies are very similar, but how your agent structures them is paramount to how you can use them and how successful you'll be in making a full banking system out of them. If you have someone you trust, wonderful. If not, I can help you find someone. So once you get your agent in place, we will get you into underwriting as soon as you can. Because remember, insurability is not guaranteed and it can disappear in an instant. So once you have your policy in place, fund it. Then utilize your collateral loans and pay yourself back. That's very important. And set up the next generation for success. So I will leave my contact info here along with some pictures of why I do this. On the left, this is me and my three kiddos. And over here on the right is one of year's calves introducing herself to one of this year's calves that hit the ground this spring. At this point, I just want to say thank you to everyone at FACT, especially Samantha and Catherine, for organizing these webinars. I've been to quite a few of them, and they make really great information available to us, which is so important. At this point, we'll open up to questions. Type them into the Q&A, and then Samantha and Catherine will help me get through them. And remember, like we've covered quite a bit of information here, and it can be a little bit mind bending. So remember that the only stupid question is the one that was never asked.
I love that. I don't think there's any stupid questions either. And I think everybody should just lay it out. We're all friends here. Christine, if you wouldn't mind putting your question into the Q&A, that would be great. And I'm going to go ahead and run our end of webinar poll. And I am so impressed with how quickly you got through this, Dana. I think that's the fastest presentation we've ever had.
I tend to get going. I get excited and I just like roll with it because it's very, very inspiring to me to be able to share this information.
Yeah, great. I love it. I love it. Okay, so our poll that we do at the end of every webinar really does help us get funding and helps us keep this program going and keeping it free for everybody. So if you could please fill that out. It also helps when I'm reporting to our board so they can see all the good work we're doing. And I think, Catherine, thank you for pointing out there's now a feature for these webinars where there's a tab at the top, the one's webinar and one says, who's Dana Wilson's screen. So you can choose to toggle back and forth. That's new. I have never noticed that before. So very exciting.
Yeah,
Okay.
we had some seems like we had some technical difficulties, maybe not on our
Yeah.
side, but on the Zoom side, audio going in and out, not being able to see. Just for everybody, I put it in the chat, but the recording will go out tomorrow. So if you missed anything, you can rewatch it all there. So no worries.
So this is the time for you guys to put your questions in the Q&A. We have so much time to answer them. So I think everybody's questions are going to get answered. I say that, but my hope is that everybody's questions get answered and we will be finished at the top of the hour at the latest. Catherine, do you want to start?
Yeah, our first question is, what happens when the values are adjusted for inflation?
Very good question. The guaranteed interest rate is part of why we put these funds into these policies so that they will grow with inflation. If we have our money sitting in a regular savings account making zero or 0.2 interest rate, we definitely are behind inflation. That's why we like these policies, because they pick up and they carry with inflation. So the very good question.
All right. So Christelle asks, if you have no children, how else could you make this work?
That's a great question too. The beneficiary would normally be our children. So we can buy policies on ourselves. That would be us being the owner of the policy, and then the beneficiary would be our children. However, it doesn't have to be our children. Our beneficiary can be any group that we want, any person that we want. You could donate all of your death benefit to FACT.
Wow, that's hopefully none of you will die anytime soon. So.
Right? But the reality is that while the death benefit is a very large part of why we do this, it's not the only part. It's the banking function, which is kind of the major driving factor, is that we want to funnel our income dollars into a savings vehicle that's actually going to provide us with some benefit, instead of just sitting there and then getting spent by us. Obviously, we have bills that we have to pay, hay bills and irrigation and all the things, right? But if we can divert our income, put it into the savings vehicle of the whole life policy, and then borrow against it, then our money continues to grow while we're using it. So even if you don't have a beneficiary that, obviously most of us have children, but if you don't, there's an absolute reason why you would use it for your own banking functions. You essentially, for me personally, I would like to stay as far away from the feds as possible, start as far away from industrial banking, if we will. And I certainly don't want to be spending any of my dollars on interest that's going out of my system. So regardless of who the beneficiary is, it's still a very important policy. And you also have the long-term care options. So if you don't have beneficiaries that will come and help take care of you, then you can hire people with part of your death benefit.
All right, our next question is a long one. What if, I guess I'll ask this as a two-parter, or what do you think, Sam? Yeah. First part being, what if a family is already in a mess because they did not do this earlier?
Oh man. This is the time machine, right? This is the reason I put the time machine, and I use the AI image for that one as well, because it's so I, I wish that I could have gone back in time and spoken to myself when I was 20, because I actually had one of these policies. I just didn't know how to use it, and I let it eat itself. I stopped paying premiums, and the dividends paid my premiums for a long time, and then they ran out and I couldn't fund it anymore. So I didn't know that I was supposed to do this. Um, so I think that the answer there is, it's hard to tell exactly what the mess is that we're talking about. That's something we can certainly go through. Remember that the first step is to identify your assets and then your liabilities and figure the whole thing out first. Then we'll go to a plan, right? So if there's a mess going on, remember that we are the ones who will set the tone for future generations. We might not be able to entirely fix it for ourselves, but we can certainly impart knowledge and actual function to the future. So yeah, I understand wanting to go back and fix something for ourselves might not be possible, but there's a lot to it. So get with an agent that you really trust and then sort through it. I mean, sometimes it's like sorting spaghetti, right? We've got to pull a noodle out and figure out what's going on over here, and then pull a meatball out and figure out how we can put it all together so that it's an actual meal.
So the next part of that question, which maybe answers some of the like the mess part of it,
Mhm.
is there something that can be done at the point that the elder family member has died? The property is now owned by two owners at one third each, who value the land as an ecological entity, not currently a productive business, and one who thinks the property is worth more than the appraisal.
Oh, don't we
Um,
all?
um, sorry, I lost my thing.
I think
From
I think that's
yeah,
probably good.
okay.
Yeah.
Okay. Yeah, so that is a good question. So you're getting into kind of dueling heirs here, right? And when we looked at that slide where we needed to fund the heirs that were not working at the same time as trying to run the continued ranch, um, this is where you're getting into wanting to schedule a buyout agreement. So if you have multiple different owners, you can own life insurance on each owner. So if one passes, then the other one has the funds, by being the beneficiary of the original owner, has the funds to buy out the family that is now experiencing a loss. So there are quite a few things that we can do. Again, it would be a good situation to go through the asset and liability conversation and figure out what the total what is the complete picture that we're looking at. We have a whole bunch of interview questions and fact finder information that we can go through to figure out what the situation is, and then make recommendations based on the individual situation.
All right. So the next question is from Whitney. Would it be possible to restructure a whole life policy, and I guess even if a term life policy, with your insurance agent?
It's very possible. It just depends on how those policies were written. Many times, and we do this as well, we'll write a whole life policy, but we'll add a little bit of term so that we have enough death benefit to solve for that problem. And then that term is actually convertible. So it's definitely something, if you have existing policies in place, go back to your agent if you can't find them, which happens sometimes. I mean, life insurance policies can be 120 years long. So if you can't find your agent, then we can definitely connect you with someone who can do a review. We call it an in-force illustration, where we look at what the terms are of your policy and then make recommendations based on what your goals are. Again, in this presentation, our goal is to pass on the ranch successfully, but you might have a different goal. So not that you don't want to pass on your ranch successfully, obviously we do, but there might be other things that you need to solve for first. So go back and speak to your original agent, and again, check and see if they understand the infinite banking concept. It's not something that every life agent is aware of. Some of them are becoming more aware because I think it is coming more out into mainstream. But it's definitely, we have to put some education as agents. We have to put some education into understanding the nuances of the policy. So go get with your agent. If you can't find them, let me know and I'll get you connected to someone who will work for you.
Our next question is from Erica, who asks, can the amount of money you contribute each year change, or do you have to contribute the same amount every year for the entire life of the policy?
That's really good. So let's talk about the reducing premiums. I think it was in year 20, we watched our rancher reduce his premium. So in that case, it can go down. And then I have to look back at the policy that we showed, the illustration that we showed, but at a certain point, no more premiums went in. So yes, there is the assumption that premiums will go down and eventually reduce to nothing. However, there's also the assumption that we want to build in some space so that you can add more premiums. because the more money that you put into the policy, the more money will earn at 3%, and the more dividends will be paid on that cash value that's sitting in there. So yes, the policies, as long as they're written properly, can be quite flexible. There's a certain amount that you can't go over, because then that's a taxable event, but as long as your agent knows what they're doing, they can make a lot of flexibility in those premiums.
All right. So Twanda actually has a very specific question to her. So I'm just going to tell Twanda to go ahead and reach out to Dana privately if you want to. And she can recommend an agent for you. So Kevin's question is, what are the best first steps to converting an existing whole life policy to the IBC concept?
Good question. First of all, let's take inventory of how it's written. What is the cash value available, and what is the death benefit? And does it match what your requirements are? If you need more death benefit, then maybe it's a matter of replacing that policy. But if it's solving for the issues that you need, that's fantastic. And usually, all the whole life policies, they're just designed so that you can borrow against your cash value. And now you just need to figure out what that process is with your own company. So again, go back to your agent. And you may, if you have a whole life policy, you probably, there's no conversion required to put it into an IBC. It's just a matter of how much cash value you have and how you're using it. So IBC, think of it this way. It's a philosophy. It's very much like ranching. And I have a whole podcast that marries the idea of ranching regeneratively to banking with infinite banking policies, because it's not the ranch that makes it regenerative, it's the philosophy. It's not the policy that makes it infinite, it's the way that you use it. So when you're taking cash value and borrowing against it, replacing your financing, your traditional financing, that makes it an infinite banking policy. It's just the whole life policy that we use because we feel like that's the best vehicle to get you what you need.
Next question is, in calculating estate value, the liabilities included mortgage and salaries. Are these annual amounts?
Those would be considered annual amounts. If we're taking, it just depends. Yeah, as an example, it just depends on how much your whole operation is running you. So when you're calculating your liabilities, we just need to lay them out. We have a whole fact finder process that we can run through, and we have an entire business valuation. So if you're less on the homesteading side, more on the actual business side, we can run you through the entire business valuation, which is something that it's just part of our program. You could go get a business valuation, which is quite expensive, but it's not something that we charge for. We just make sure that you have a clear picture of what your business valuation is, and then you can work from there. So if that's something that you're interested in, that's also a piece that we can help with.
Dana, before we go further, could you share the name of your podcast with us?
It's called Roots and Reserves, and it will be out shortly, and I will make sure that I get you a link for that.
Okay, that'd be great. I'll put that in the follow-up email.
Great.
Travis asks, why not just have a term life insurance policy that can be a death benefit to your heirs who don't want to own and manage the farm, cover enough to pay off their portion and all outstanding expenses?
Yep, absolutely. And in that case, you are solving specifically for the death benefit. What a term policy doesn't do is solve for the banking function. And it doesn't, because it doesn't create cash value. So when you buy a term policy, it's like you're leasing the life insurance. You have a specific period of time. So usually they're 20 to 30 years. And if you die during that time, then your beneficiaries get paid. Whereas in a whole life policy, it's more like you're buying the house. So your whole life policy runs your death benefit until you die. And so it doesn't matter when during the period of that policy you pass away, the death benefit carries on. So term is not necessarily bad in terms of the premium that you have to pay. It's a lot less expensive in terms of, I'll spend $100 a month and I'll get a much higher death benefit for a term policy. However, you better hope that you died during that term. Otherwise, at the end, on day one, at the end of that term policy, it's gone. And if you decide at the end of that term, let's say 20 years, on the year 21, that you want to renew that policy because you're still living and you want to continue to take care of your beneficiaries, the premiums are absolutely insane. So it's not necessarily something that we can renew. So yes, it is possible to provide a death benefit with a term. Of course it is. It's just a matter of how we want to use a banking system and how we want to ensure that our beneficiaries get the death benefit. That was something that I had also as a young person when my daughter was just a baby. I got a term policy, and then she turned 20 and it's about to turn 20 and it goes away. So I propose that she needs the amount more now than she did when she was little. When she was little, she has lots of family members who can take care of her. Now, as an adult, if I leave and I don't leave her with anything, I feel like I've failed.
The next question is, what are your thoughts on life estates?
Interesting. Tell me more about what we are talking about in terms of life estates. If we're talking about like a living trust, then yes, 100%. We need to have all of our information in all of our assets, all of our liability, everything inside our living trust with clear instructions. So I'm not exactly sure what we mean by life estates.
Yeah, feel free to put a follow-up in the
Please, yeah.
Q&A, that anonymous attendee. Oh, I see, they've added life estates versus trust. Is that any clearer?
No, not for
Okay.
me. However, let me refer you back to your estate attorney. That is the person who's going to give you advice on that. There might be a tool or something that they use that the estate is in conjunction with infinite banking, but it doesn't replace infinite banking, nor does infinite banking replace the living trust or whatever the estate attorney is setting up. Definitely get with someone on that end.
Another similar question, just while we're there. Someone asked, could one use BTC to structure similar infinite banking? Do you know what BTC is? Because I do not.
I do not.
Okay.
I love
Too many
this.
acronyms in this world.
There are so many acronyms.
All right. Somebody asks, if I am not insurable and one of my heirs is a minor, can I start a policy on them, or do I need to wait until they are an adult?
Perfect question. The answer depends. If you are currently not insurable, but you already had life insurance on yourself, you can get a policy on your minor heir up to half of the total of life insurance that you have, the death benefit that you have on yourself. So if you're currently not insurable, meaning you can't get another policy, but somewhere along the line you got a $500,000 term policy, you'll be able to get up to $250,000 for that minor heir. The other piece of that information, which is if you're not insurable, there are other people besides just your heirs that you could potentially get insurance on. For example, if you're in a partnership, you can use key person life insurance so that you can fund buyout agreements. Very, very similar to what they do in just regular business life insurance. So yes, if you're not insurable, let me know, let someone know, let your agent know, and work towards finding someone who is insurable so that you can take your income and put it into a place where you have access to the cash value while it's earning the interest. That's the other question a lot of times is, well, if I'm not insurable, then why would I even try to do this? And the answer is so that you can take your income and park it in a place where it's earning compounding interest.
We've got a follow-up question about changing contribution amounts over time. They say, as my business income grows, I want to contribute more than what I can reasonably afford to contribute today. Are there limits to how much additional money I can contribute every year over the premium I originally established?
There are limits, And again, this is where the agent comes into play. And if we can kind of predict that there's some possibility that you would want to dump in, that happens for my business as well. I mean, we have a sale, or maybe we sell a horse or something, and then now I have all this extra money that I need to try to dump into my system. Two things. One, you can add additional policies at the time that you need to create more room for your cash value. So that's a possibility. But again, insurability comes into a factor at that point. But when you originally write the whole life policies, there's this creation of space where if we buy a little bit more death benefit, like with a term that's a convertible, then we can increase our not expenditures, but our premiums later. So yes, there is definitely some room for maneuvering. Again, your agent is the one who is going to be the best at maneuvering that way.
Oh, you're muted, Sam.
Thank you. When looking for an insurance agent, do I just ask if they are familiar with infinite banking?
You certainly can. I would kind of leave it a little bit more open-ended and ask, how can your agent set up a policy to make sure that you can get the most benefit out of your cash value, and see what they say, because you're kind of setting them up. If you just say, are you familiar with infinite banking, then the generic answer can be yes. But I'm here to tell you, lots of people can say yes and really not know the intricacies. And it's the intricacies that make the policies very effective or not effective. So open it up a little bit. First of all, do a little bit of research on your own so that you can understand what the message is. If they say yes and they fill in some information for you, you want to be able to compare what I've said. There's a lot of books that you can read and understand whether what they're saying actually makes sense. So education of our own worth is very, very important.
Yeah, well, that was the last question, Dana, and thank you so much. That was such great information. I really appreciate the time you took to pull this together, and all the information that you shared.
Thank you so much.
Yes. So hold on a second.